Welcome back to the deep dive. We've got a fascinating one for you today, tearing into a stack of sources all about Xeris Biopharma Holdings.
Yeah, Xeris. NASDAQ ticker XERS.
Right, and we're talking about a company that's navigating that, pretty challenging biopharma space, but is actually showing some really impressive revenue growth and notably hit positive operational cash flow recently, which is, well, that's quite a milestone.
It absolutely is. And looking at the sources at a reference price of, $4.93 and a market cap around $791 million.
As of June 1st, yeah.
Yeah, they're definitely in that sort of small cap biotech world, focused on specific areas, endocrine, neurological, and gastroenterological diseases.
So our mission for you today, diving into these sources, is to really unpack what's driving that growth, understand the challenges, and, figure out what really matters most here.
And just a quick interlude before we jump in, like and subscribe to Stock Analytics AI, Euro 4.99 IDA members. Give a ticker, get prioritized deep dive analysis earned.
Trust us, you'll want to stick around to the very end. We're going to leave you with a provocative thought, kind of steps back from the immediate numbers, and hints at where the true long-term value of this company might actually lie. It's pretty interesting.
Yeah, definitely. So make sure you're subscribed to the podcast feed so you don't miss that or any future deep dives.
Okay, let's unpack this company then. At its core, Xeris is a commercial stage biopharma company.
Right. That means they have products actually on the market generating revenue. That's a crucial distinction.
Absolutely. But they're built on something, well, kind of unique. These proprietary non-aqueous formulation technology platforms.
These platforms, called Xerisol and Xeriject, they're quite interesting, actually. Their fundamental goal is to take injectable and infusible drugs.
The kind that often need mixing or refrigeration.
Exactly. And make them ready to use and, importantly, stable at room temperature.
Think about the patient experience there. I mean, no more fiddling with vials and syringes, right? No need to keep things constantly cold.
Right. The sources really highlight this is all about improving convenience and, well, potentially better outcomes, too, because adherence could improve. Easier to take, maybe you take it more consistently.
Makes sense.
And the company itself is really in a bit of a transition phase. Yeah. They've been historically R&D heavy, focused on development.
Right.
But now they're actively pivoting to be more commercially driven. They have a stated goal of achieving sustained profitability and consistent positive cash flow.
And a big catalyst for that shift, as the sources point out, was that 2021 acquisition of Strongbridge Biopharma.
Strongbridge.
That deal brought in products like Recorlev and Kevey. It significantly expanded their commercial footprint, their market presence.
Exactly. It fundamentally changed the trajectory of the company, from primarily development to having a significant commercial engine already running.
Okay, so let's dive into that commercial engine first. What are the key products actually bringing in the revenue right now?
Well, the main ones highlighted in the sources are Recorlev, Garvoq, and Kevey's.
Recorlev really jumps out from the numbers. It's an oral medication for endogenous Cushing's syndrome.
Right, for adults where surgery isn't an option or didn't work out.
And its performance. Yeah. Well, it's been pretty exceptional, according to these sources. Q1 2025 revenue was $25.5 million.
Yep, $25.5 million. That's a massive 141% increase year over year.
Wow.
And for the full year 2024, revenue was $64.3 million, which was up 118%. And this isn't just like price hikes. It's driven by genuine patient growth, up 124% in Q1 2025 alone.
That's some serious traction. The sources note it's targeting a market estimated to be over $1 billion.
$1 billion plus, yeah.
And it benefits from U.S. orphan drug exclusivity until late 2028, plus patent protection way out to 2040.
Yeah, that exclusivity is key. It sounds like it's truly filling an important need for, a specific group of underserved patients.
Okay, moving to Gvoke. This is their ready-to-use glucagon injection for severe low blood sugar in people with diabetes.
Right. Adults and kids, age 2 and up. And it comes in multiple formats, like an auto-injector, pre-filled syringe, and a kit. Makes it pretty versatile.
And they also recently got FDA approval for a diagnostic use, right? Gvoke Vial DXE.
Exactly. That's a separate revenue stream through a partnership they have with American Regent. So another way to leverage the Gvoke product.
Gvoke seems like a consistent, growing contributor. Q1 2025 revenue was $20.8 million.
Solid 26% increase year over year.
Yeah, and full year 2024 was $82.8 million, up 24%, prescriptions growing right alongside that.
And it holds a significant slice of the retail glucagon market share, around 35% in late 2024.
And that ready-to-use format, I mean, that's the key differentiator, isn't it? Enabled by their tech.
Absolutely. Compared to those older glucagon kits that required manual mixing, well, that can be really stressful during an emergency hypoglycemia event. This is just grab and go.
Makes a huge difference. Okay, now let's look at Kivis. This is an FDA-approved treatment for primary periodic paralysis, PPP, a rare genetic neuromuscular disorder.
Keyvase is a bit of a different story right now. It seems to be facing some headwinds.
Yeah, the numbers show that. Q1 2025 revenue was $11.4 million, down 13% year over year. FY 2024 saw a similar decline.
And the sources make it pretty clear why. Its orphan drug exclusivity ended back in August 2022.
Okay. So generics.
Exactly. It's now dealing with generic competition from companies like Torrent. Cyclor Malvi is mentioned too.
It's a really clear example of how valuable that regulatory exclusivity is and, well, the challenge once it expires.
Definitely. It highlights the life cycle of these niche drugs.
They also have a smaller revenue stream, royalty contract, and other revenue.
Yeah, that comes from collaborations where other companies use their technology platforms. It's variable, but it does show validation, right?
Yeah.
Others are willing to pay to use their tech.
Like the milestones mentioned from Beta Bionics and American Regent.
Right, which brings us nicely back to those proprietary technology platforms, Xerisol and Xeroject.
Xerisol for peptides and small molecules, Xeroject for the bigger stuff, biologics.
Yeah. And the sources really emphasize the advantages. Ready to use, stable at room temperature.
No reconstitution needed.
Right. Potentially smaller injection volumes, which is more comfortable. And opening up alternative routes like subcutaneous or intramuscular instead of just intravenous.
So the value proposition seems pretty compelling. Simplifying how drugs are given, improving the patient experience.
And potentially reducing healthcare costs, right? Maybe moving treatments out of clinics if they're easier to self-administer.
And they have a pretty extensive patent estate protecting this technology. Sources highlight that as a key asset.
Yes, lots of granted patents, more pending. That IP is crucial.
They've also had partnerships. You mentioned Beta Bionics, Regeneron 2, validates the tech further.
The sources do mention a past Amgen deal termination, but specifically note it wasn't due to issues with the technology itself. That's an important clarification.
So for you listening, understanding these platforms is really crucial because they're positioned as, well, foundational to the company's future value, not just supporting the current products on the market.
Exactly. It's about potential future applications too.
Speaking of the future, let's look at their R&D pipeline. The main focus here, according to the sources, is a candidate called XP8121.
Right, XP8121. This candidate is a once-weekly subcutaneous formulation, so an injection under the skin of levothyroxine.
Levothyroxine. That's the standard treatment for hypothyroidism, right? Taken as a daily pill by millions.
Exactly. So why develop a new version?
Yeah, why?
Well, the sources say it's targeting the known challenges with the current daily oral therapy. Things like variable absorption food or other meds can interfere.
Right, you have to take it on an empty stomach, wait to eat.
Yeah, and just the hassle of taking a pill perfectly every single day at a specific time. A once-weekly shot could potentially offer improved convenience and maybe even better, more consistent thyroid level control for patients.
Okay, so where is it in development?
It's currently phase 3 ready. They've agreed on the design for a single pivotal phase 3 trial with the FDA, which happened late last year.
And the market opportunity here sounds huge.
It's enormous. We're talking 15 to 25 million patients just in the U.S. with hypothyroidism. Management sees this as a potential billion-dollar-plus opportunity for XP8121.
Within an already massive multi-billion-dollar global market for thyroid hormone replacement.
Right, and management really seems to be emphasizing this. It was apparently a big focus of their recent analyst and investor day.
Makes sense. And their R&D spending around $30 million annually is primarily backing this project.
That's what the sources indicate, yeah. Consistent spending to push XP8121 forward.
So for you, the listener, this pipeline candidate represents, well, significant future upside potential, a potential blockbuster.
But it also comes with all the inherent risks and the significant investment required for late-stage clinical trials and getting regulatory approval. Phase 3 is tough.
Okay, so where does Xeris actually fit in the competitive landscape with its current products and this big pipeline hope?
Well, they operate in quite distinct markets, but they're all competitive. Cushing's has several established players like Korlym, Signifor, Isturisa, plus off-label use and emerging therapies.
And the glucagon market.
That's shifting towards ready-to-use options like Galavogue. But they compete with Bashimi from Amphastar, Zigalog from Zelenova Nordisk, plus the older kits still exist.
primary periodic paralysis, we know Kayvase faces generics now.
Right, and off-label use of other drugs too.
And hypothyroidism for XP8121. That's a massive established market dominated by cheap, generic oral therapy.
Exactly. XP8121 would really need to carve out its niche based purely on that differentiated formulation and convenience factor, the high bar.
So compared to the big pharma players, Xeris is definitely smaller. They rely on these differentiated products, finding specific patient niches, and leveraging that core technology.
Which means their ability to execute commercially is absolutely critical. They have to be sharp.
On the regulatory front, standard FDA and international oversight, of course. That orphan drug status for Recorlev, giving exclusivity until 2028, that's a major asset.
It is. But as we saw with Kayvase, losing that exclusivity dramatically changes the game. The clock is ticking on Recorlev's exclusivity too.
And their IP, the patents on products, and the tech platforms, that's a big part of their potential economic moat, right? Protecting Gvoke to 2036, Recorlev maybe past 2040.
Yeah, but the sources suggest the long-term strength of that moat really depends on continued innovation and their ability to actually defend those patents if challenged. Temporary regulatory protections only go so far. The tech itself is maybe the more durable advantage if they keep building on it.
Okay, let's shift gears then and look at the people leading the company. Management evaluation.
So the CEO is John Shannon. He stepped into the role in August 2024, but he wasn't new. He was COO and president before that, since 2017.
Okay, so deep company knowledge. And his background.
Over 35 years in pharma. Sources highlight experience in sales, marketing, operations, strategy, business development, a pretty broad background. And importantly, a track record of launching and scaling major brands, including some billion-dollar products earlier in his career at places like Baxter.
That experience seems quite aligned with where Xeris is now, right? Focusing heavily on commercial execution, scaling up sales, operational efficiency.
It does seem like a good fit for this phase. The sources also mentioned other key execs, Kevin McCulloch as president and COO, Stephen Piper as CFO, Beth Hecht as chief legal officer, and they brought in a new chief medical officer on Ongwan in early 2025. Paul Edick, the former CEO, is still involved as a senior advisor.
What about analysts' sentiment around the company and management?
Generally positive, it seems. Ratings mostly lean towards moderate buy or buy. Price targets typically suggest potential upside from the current level.
But you said there's a range.
Yeah, there's a noticeable range, like $4 to $8 maybe, average around $6.25, $6.40. So it shows differing views among analysts, some uncertainty baked in.
And management's communications, what are they emphasizing?
Consistently hitting on growth acceleration, disciplined execution, improving the financial picture, and achieving that positive adjusted EBITDA. It all aligns with their strategic pivot towards being a commercial entity.
Okay, what about the board of directors? Any changes there?
Yeah, some changes noted in early 2025. A couple members leaving or not standing for re-election. A new director appointed James Brady, who brings pharma and finance expertise. The board size was planned to be reduced slightly to 8 members. Marla Persky is the independent chairperson.
And independence.
A majority of the board is independent, which is generally seen as good for corporate governance. They have the standard committees: audit, compensation, nominate, and governance.
Looking at governance more broadly, like executive compensation.
The sources state it's designed to align leadership's interests with performance and shareholder value. A good chunk of pay is tied to stock awards and incentives.
We saw some data for 2024. Shannon's total comped around $3.8 million.
Right, and CFO paper around $1.85 billion. Significant portions were equity-based, which helps with that alignment.
Shareholder alignment also comes from direct ownership, right? Insiders owning stock.
Exactly. Insiders own a notable percentage, somewhere between maybe 3.9% and 9.2% total, depending on the source. CEO Shannon himself holds about 0.55% to 0.6%.
And institutional ownership, big funds.
That's substantial, roughly 43% to 44%. Major firms like BlackRock, Vanguard, Geode, State Street are listed as holding positions.
So why does who owns the stock matter for you, the listener?
Well, it gives you insight into how aligned the people running the company, the insiders, and the big professional investors are with your interests if you were considering becoming a shareholder. High insider and institutional ownership can be seen as a positive signal, a vote of confidence.
Makes sense. Any red flags on ethics or legal issues?
The company states core values: patience, accountable, right thing, innovation. They have a code of conduct. And their 2024 10K indicated no material pending legal proceedings at that time. So nothing major jumping out from the sources there.
Okay, let's talk capital allocation. Where are they putting their money?
The strategy seems pretty clear. reinvesting back into the business, specifically focusing on commercial growth, especially for Recollev, and funding the R&D for XP-80-121. The big goal is achieving self-sustainability, funding themselves through their own cash flow.
And we saw that reflected in the financials, right? Increased selling, general and admin expenses, SG&A, for commercial expansion.
Around $165 million in FY 2024.
And sustained R&D spending for the pipeline, around $30 million.
Right. And because they use contract manufacturers, CMOs, their direct capital expenditures, like building factories, are relatively low. Minimal CapEx.
The Strongbridge acquisition was obviously a huge strategic investment a few years back.
That was their major M&A move. For financing ongoing operations, they've used both equity raises and debt. They recently refinanced a big term loan in early 2024.
That was the Hafen loan, $200 million.
Yeah, refinanced it. The goal was to lower their interest costs and get some working capital. They also have convertible notes outstanding, maturing in 2025 and 2028. So debt management is definitely part of the picture.
And dividends or buybacks?
Nope. No history of either, which is pretty standard for a growth-stage biopharma company pouring money back into growth. Plus, their credit agreement likely limits that anyway.
So their spending choices really reflect those priorities. Grow the commercial products, push XP-80-121 forward.
Exactly. It shows where they see the value creation coming from.
Okay, so that covers the business, the tech, the pipeline, the team. But how is all of this actually translating into their financial health? Let's dive into the numbers, the financial health chapter.
Right, let's get into it. The revenue growth trend, as we touched on, has been quite strong.
Yeah, $110 million in 2022.
Then $164 million in 2023. That was a 49% jump. Then $203 million in 2024. Up another 24%.
And Q1 2025 continued that, right? $60.1 million, up nearly 48% year over year.
Exactly. So a consistent upward trajectory on the top line. That's positive.
And their gross margins look really impressive, consistently in the 80–85% range.
Yeah, very high gross margins. That tells you that after covering the direct costs of making the products, a large percentage of each revenue dollar is left over. That's a really strong point for their future profitability potential. Shows pricing power or efficient manufacturing, likely both.
But operating expenses have been significant.
Understandably so, yeah. With the investments in R&D for the pipeline, and particularly SG&A to build out that commercial infrastructure and sales force, historically, this has led to operating and net losses.
But here's where it gets really interesting, right? The trend in those losses. They've been narrowing considerably.
Hugely. Their operating loss in Q1 2025 was down to just $3.1 million. Compare that to a $39 million operating loss for the full year 2024, or even bigger losses before that. It's a dramatic improvement. Net loss also narrowing.
And the key metric management seems focused on adjusted EBITDA.
Right. Adjusted earnings before interest, taxes, depreciation, and amortization. It's a non-GAAP measure, but it aims to show operational cash profitability. And this shows a critical positive shift.
They hit positive adjusted EBITDA when Q4 2024.
Yeah, $8.3 million in Q4 24. Yeah. And again, positive in Q1 2025, $4.4 million. For the full year 2024, it actually squeaked into the positive at $1.2 million.
That really feels like a key inflection point. It suggests the core operational business is now generating enough cash to cover its operating expenses, actually outpacing the growth in those costs.
It's a sign that their commercial engine, fueled by Recollev and Gvoke growth, is starting to gain real leverage and efficiency.
Okay, let's pivot to the balance sheet. As of Q1 2025,
they had $58.4 million in cash on hand. Total assets were about $315.5 million. Important to note, that includes significant intangible assets like $96 million and goodwill around $23 million, mostly from that Strongbridge acquisition.
Right, those aren't physical assets. On the flip side, liabilities, debt.
Total debt principal was around $248.8 million. That includes the term loan and those convertible notes. Total liabilities overall came in at $350.6 million. Which results in negative stockholders' equity, a deficit of $35.1 million in Q1 2025. Assets are less than liabilities on the books.
Their current ratio and quick ratio, looking at short-term liquidity, seem okay, like 1.7 and 1.16.
Right. Yeah, suggesting they can cover near-term obligations. But that substantial debt load and the negative equity are really important factors to keep in mind. They represent significant financial leverage risks, even with the improving operational picture.
Definitely. Okay, let's look at cash flow, maybe even more critical than reported net income for a company at this stage.
Absolutely. Historically, operating cash flow has been negative. They were burning cash just to run the day-to-day business.
But the sources show a trend towards positive here too, right?
Definitely improving. They actually generated positive operating cash flow in Q4 of 2023 and again in Q4 of 2024. For the full year 2024, it was still a small use of cash, about $3.3 million used. But the trend is clearly moving in the right direction, narrowing that burn significantly from prior years.
And achieving sustained positive operating cash flow is the goal, right?
That's absolutely crucial. That's the cash generated from the business itself. It can then be used to fund ongoing operations, reinvest in R&D for XB8121, and really importantly, start servicing and ultimately reducing that big debt load without needing to constantly go back to the markets for more financing. Self-sufficiency.
And because they outsource manufacturing, their capital expenditures are quite low.
Very low. Typically just around $1 million annually. That helps their overall cash flow picture, less cash going out for big capital projects.
So free cash flow, which is operating cash flow minus CapEx, has historically been negative, but it's following that same improving trend as operating cash flow.
Exactly. The gap is closing.
Let's briefly touch on ROIC versus WACC, return on invested capital versus weighted average cost of capital, a bit technical, but important.
Right. It basically asks, is the company generating returns on the money it has invested, debt and equity? They're higher than the cost of getting that money.
And for Xeris,
based on the sources, their estimated ROIC has been negative, like negative 28% in 2024, or maybe vigor 15% on a trailing 12-month basis recently, according to one source. That's significantly below their estimated WACC, the cost of capital, which is maybe around 9%.
So what does that mean in simple terms?
It means they are not currently generating returns above the cost of funding those investments. From a pure financial efficiency standpoint right now, they aren't creating value. This isn't unusual, though, for a growth-stage biopharma company that's investing heavily in R&D and commercialization, building for the future.
So the investment thesis relies on that changing.
Exactly. The whole bet is that as profitability grows, driven by product sales and maybe the pipeline, their ROIC will eventually climb above their WACC, and they will start creating significant value down the road.
Okay. Finally, for financials, let's look at their 2025 guidance and outlook. What are they telling the market?
Management recently tightened their full-year 2025 revenue guidance to a range of $260 million to $275 million.
At the midpoint, that's over 30% growth compared to FY 2024. Pretty strong continued growth expected.
Yes, and crucially, they expect to be adjusted EBITDA positive throughout all of 2025. Not just for the full year, but consistently positive.
Management seems pretty bullish, calling 2025 a financially transformative year, driven by that growth, improving margins, and disciplined spending.
They do. It's worth noting, though, that analyst consensus estimates for FY 2025 revenue are actually a bit below the company's guidance range, maybe closer to $244 million on average.
Interesting discrepancy in analyst EPS estimates. Earnings per share.
Still negative for both 2025 and 2026 on a GAAP basis, according to the averages, maybe around negative $0.37 for 2026 for 2026.
Okay, so that difference is really key for you, the listener, to understand. Management is guiding to positive adjusted EBITDA.
Right, which excludes things like interest expense, depreciation, stock comp.
But analyst GAAP EPS estimates, which include all those things, particularly the significant interest expense on their debt, are still showing net losses for now.
Exactly. It highlights that achieving actual GAAP profitability, the bottom line net income, will be a further step beyond achieving that operational adjusted EBITDA profitability. Managing that debt interest is a big factor there.
Got it. And just a reminder, you can find links to all the source material we've been digging through today right there in the episode description if you want to explore further.
Definitely check those out.
Okay, moving into the second half of our deep dive. We've covered the business, the leadership, the financials. Now let's look at the external view market sentiment, who owns the stock, and crucially, the key risks.
Right. We touched on the competitive landscape earlier. They're definitely operating in distinct markets, but yeah, all of them are competitive. Established players, emerging treatments. It's not an easy space.
And as we mentioned, analyst views seem generally positive, right? Suggesting potential upside from the current price, although that range in price targets shows there's not complete agreement on exactly how much or how certain that path is.
Yeah, that range, $4 or so, reflects differing opinions on execution risk, pipeline value, competition, etc.
And that's significant institutional ownership, around 43–44% by major firms. That's often seen as a signal of confidence from the big professional investors who've likely done significant due diligence.
It suggests they see long-term potential despite the risks.
Let's just quickly revisit the ownership structure itself.
Yeah, we discussed that insider ownership by management and the board is notable, somewhere in the 3.9% to 9.2% range overall.
CEO Shannon around 0.55, 0.6%.
Right, and that's substantial institutional ownership by BlackRock, Vanguard, State Street, and others.
And again, for you, this ownership structure matters because it shows the degree to which the people running the company day to day and large sophisticated investors have their own skin in the game aligned with potential new shareholders.
It's definitely a factor to consider in the overall picture.
Okay, now let's talk risk assessment. Because, let's be honest, with any investment, especially in biopharma, there are significant challenges and potential bumps in the road. The sources highlight several key factors to consider here.
Absolutely. Gotta look at the downsides, too. First up, there's commercial success risk. Can they keep that growth trajectory going for Recorlev and Gavoke? It's not guaranteed.
And the KV situation is a stark reminder, right? Losing exclusivity, facing generics, that can really hurt sales quickly.
Exactly. It shows what happens when protection expires. Competition risk is also ever present. They are going up against much larger companies, the big pharma players, who just have vastly more resources across all their markets.
Supply chain risk is mentioned too. They rely on third-party manufacturers, contract manufacturing organizations, CMOs.
And sometimes single-source suppliers for key components or APIs.
Yeah.
Any disruption, a quality issue, a factory problem, geopolitical stuff, inability to scale up production could directly impact their ability to get product to patients and meet sales forecasts.
IP risk is crucial for a tech-based company like this. Their competitive edge is really tied to those patents on the technology and the specific product formulations.
Yeah, if they can't successfully obtain new patents, maintain the ones they have, or defend them against legal challenges, it could seriously erode their market position and pricing power.
And then there's pipeline risk. That's a big one, centered primarily on XP8121.
Huge one. Advancing a drug through phase 3 trials is notoriously long, incredibly expensive, and inherently uncertain. Clinical trials can fail for efficacy or safety reasons.
And even with positive trial results, regulatory approval from the FDA isn't guaranteed. They might ask for more data or just say no.
Right. It's a high-stakes bet. Financial risk is also prominent, as we discussed. They have that history of net losses, a significant accumulated deficit on the balance sheet.
And achieving sustained JAK profitability isn't a given yet. They still need to overcome interest expenses and other costs.
And they have that substantial debt burden that requires ongoing significant cash flow just to service the interest payments, let alone pay back the principal eventually. The sources also note there are restrictive covenants tied to their debt agreements, which could limit their operational flexibility if things go wrong.
And, of course, there's the ongoing risk of regulatory compliance. Changes in regulations, manufacturing inspections, potential restrictions or recalls, always a factor in pharma.
Definitely. Beyond those company-specific factors, the sources highlight an external risk that's newly relevant: the potential impact of U.S. tariffs implemented in 2025.
Yes, the tariffs. This is an interesting and potentially complicating factor. The new tariffs include a general 10% on many imports, potentially higher on specific things like active pharmaceutical ingredients, APIs from China.
So how could this impact Xeris, according to the sources? Well, one key way is through increased cost of goods sold, or a COGS. If they're contract manufacturers or their suppliers further down the chain who might be sourcing components or APIs globally, maybe from places like Taiwan or Israel, as mentioned, or elsewhere, if they get hit with tariffs on imports coming into the U.S.
Those increased costs could get passed on to Xeris?
It's quite possible, yeah.
Yeah.
Which could potentially put pressure on those nice high gross margins we talked about.
Okay. What else?
There's also the risk of supply chain disruptions. Tariffs can cause suppliers to suddenly shift sourcing strategies to avoid duties, which can create instability. Given Xeris's reliance on limited or single sources for some things, any hiccup in their established supply chain could cause problems getting product.
The 2024 10K even flagged risks like geopolitical issues and export delays, so this fits into that category.
Exactly. Higher operating costs due to tariffs could also theoretically pull funds away from other important areas, like the R&D budget for XP8121.
And pricing, can they just pass the costs on?
Maybe, maybe not. Trying to pass those higher costs on to payers or patients could face significant resistance, especially in competitive markets. Absorbing them hurts profit. It's a tough spot.
Are there any mitigating factors mentioned?
Some potential ones, but with limitations. Their market focus is primarily the U.S., which reduces direct export tariff risk on their finished goods. Their proprietary technology might give them some limited pricing power to absorb costs. Long-term contracts with their CMOs could offer some speculative protection.
But that's not guaranteed.
Right. And the sources also note that finding alternative suppliers quickly if needed can be complex and time-consuming, especially for specialized pharma manufacturing. Limited options.
So the overall assessment seems to be a moderate vulnerability to these tariffs.
Yeah, that seems fair based on the sources.
Yeah.
The main risks appear to be those increased COGS potentially squeezing margins and the possibility of supply chain headaches. It's another financial challenge they need to navigate carefully, particularly given their existing debt and their goals for achieving solid profitability.
Okay, wow. We have covered a lot of ground here. Let's try to bring it all together in our conclusion.
Sounds good. Let's sum it up.
So to quickly recap for you, Xeris is a company showing, well, pretty impressive growth, particularly driven by Recorlev and Gvoke. That growth is built on these innovative drug delivery technology platforms, Xerisol and Xeriject.
They're actively transitioning to a commercial focus, moving away from just R&D. And they've reached a really significant milestone with achieving positive adjusted EBITDA, which signals improving operational profitability. That's a big step.
And they also have that potentially huge future opportunity waiting in the wings with the XP8121 pipeline candidate for hypothyroidism.
But as we've spent a good amount of time discussing, they face substantial challenges too. There's that considerable debt load, the history of net losses leading to negative equity on the balance sheet.
Intense competition across all their markets.
Right. The reality of generic erosion hitting products like Kiva's once exclusivity is lost. And now, this new potential headwind from U.S. tariffs impacting their supply chain and costs. It's not a smooth ride.
So, based on the sources, the investment profile here looks, well, pretty speculative, wouldn't you say?
I'd agree. Likely best suited for someone with a higher risk tolerance, a long-term view, and who really understands the specific dynamics and risks inherent in the biopharma industry. It's not a set it and forget it type of situation.
Key factors to absolutely keep your eye on moving forward would be what?
Definitely the continued revenue trajectory of Recorlev and Gvoke. Can they sustain that growth? The clinical and regulatory progress, or lack thereof, for XP8121, that's crucial for the future story. Their ability to manage operating expenses effectively and generate sustained positive operating cash flow.
How they plan to address that debt load over time.
Yes, debt reduction strategy. And how they successfully navigate these potential tariff impacts without disrupting supply or margins too much. That's to monitor.
Valuation is tricky here too, isn't it? With negative equity, traditional asset value metrics don't really apply.
Not really. The market value is clearly forward-looking, based on expectations of potential future cash flows from their current products holding up and, importantly, the pipeline delivering.
Analyst targets suggest moderate upside on average, but again, that range.
Exactly. Doing your own detailed assessment of intrinsic value, considering different scenarios, and applying a margin of safety is really crucial here, more so than just looking at analyst targets.
Okay. And that brings us back, finally, to that provocative thought we teased way back at the beginning.
The bigger picture question.
Right. While so much of the market focus, and frankly what we spent a lot of time on today because it's important, is Xeris's journey towards profitability based on the success of Recorlev and Gvoke.
And the huge potential, but also risk, of XP8121.
The true aha moment, the really big picture question to maybe leave you thinking about, might be whether their core unique drug delivery platforms that Xerisol and Xeriject Tech aren't just tools to support their current internal products.
Could these platforms actually fundamentally change how a much wider range of other crucial therapies owned by other companies are delivered in the future?
Could they open up entirely new, potentially massive, revenue streams and market opportunities by enabling better, more convenient, more stable formulations for partners across the industry, way beyond Xeris's current focus on endocrine, neuro, and gastro diseases?
Is XP8121 actually the biggest prize here long-term? Or is the underlying Xerisol Xeriject technology platform the real long-term game changer? The thing that could unlock value in ways maybe the market hasn't fully appreciated or priced in yet through partnerships and licensing.
Something to ponder as you consider this company and its future. A lot to think about there.
Definitely food for thought. And while you're mulling that over, subscribe to the Stock Analytics AI YouTube channel.
And just our standard reminder, this deep dive is based solely on the source material provided to us for this specific analysis. Investment decisions involve risk and should always be made in consultation with a qualified financial advisor who understands your individual circumstances and risk tolerance. This discussion is purely for informational purposes.
Thank you for joining us for this deep dive into Xeris Biopharma.
We really hope this gave you a clear, nuanced picture of the company based on the sources we had. We encourage you to check out that source material yourself, dig deeper if you're interested, and definitely keep thinking about that long-term potential and the risks of their core technology. We'll catch you on the next one.